Hi everyone, this is Ted Bauman, editor of the Bauman Letter. I get many emails from people who ask questions about the relationship between the different parts of the Banyan Hill Publishing Company. I think I get them because so many people subscribe to the Bauman Letter as a result of a trial offer that you got from one of my colleagues' products like Matt Badiali or Michael Carr or Paul Mempili, Ian King, somebody like that. So in other words, my own list is big and diverse, and it incorporates many different kinds of investment styles and many different kinds of interests amongst my readership. Now, I know it can be confusing when you first sign up for a financial newsletter because you start seeing offers to consider some of the other products and you start asking yourself, well, you've convinced me that I should subscribe to, let's say, Paul Mempili services, but now you're telling me that Chad Shoup is also a great opportunity. I'm confused. I don't know what to do. Well, it's a valid question. Remember, we're in the newsletter business. We have different gurus on our staff who have a deep insight into different ways of making money. And in my case, ways of preserving money as well. We try to be diverse product offerings. So today I want to give you a 30,000-foot view of the Banyan Hill franchise. How do you make sense of it all? Well, first, remember that investing is not a one-size-fits-all activity. There are many different ways to invest and many different styles of investing. If you set up a retirement account, for example, one of the first questions they'll often ask you is, what type of investor are you? Do you lean towards aggressive risk-taking, or are you a conservative type of investor who wants to maintain capital? Well, right there's a variable in determining the various products we have. Some of our guys focus on small cap stocks that are poised for explosive growth, for example. But that's a higher risk strategy because in those kinds of portfolios, some of these up-and-coming small cap firms are not going to succeed and we won't make the money that we'd hoped. But because our guys are so good overall, they're going to pick more winners than losers. You just have to have a strong constitution and an appetite for risk, and you have to be willing to see some of your bets fail. Now, that's riskier than some of the other products we have, such as, for example, the Smart Money system, which is embedded in my Bauman Letter. That's a strategy that's designed to accumulate steady gains and maintain those gains over time with minimal downside. In other words, you don't lose very much, but you also don't get big 1,000, 2,000, 3,000% gains. So you don't get the big gains, but you don't get the big drops. As a result, you don't have to worry as much. You can rest a little bit easier. So the first thing to understand about the relationship between some of the different parts of Banyan Hill Publishing is that some of us are suited to more aggressive, more risk-taking types of investors, and some are suited to the other kind. Having said that, I know that many of you are retirees, and you may feel that you haven't saved enough for retirement. You want to maximize your returns to catch up, but minimize your risk so you don't lose it all. Well, that's what everybody wants to do at all stages of their investing lives, isn't it? But when you're retired and you no longer have income streams from work, it's really important that you maintain the underlying value of your portfolio. You don't want to risk it with big bets by swinging for the fences because you don't have income streams to replace it. So in that case, we have a lot of products that are designed for people who are willing to take relatively larger risks, but with relatively smaller amounts of money. For example, Chad Shoup's and Michael Carr's option services. Those allow you to invest relatively small amounts and make fairly big gains over a short period of time because you're trading in options rather than buying and holding stocks. The only problem with that is that it's a very active sort of hands-on strategy. It's something you must be prepared to monitor at all times. If you sign up for a product like that, you can't buy a few recommendations and sit back and watch them grow as you can, for example, with the Alpha Stock Alert or the Smart Money Alert or one of Paul's services, for example. Instead, you need to be actively on top of the everyday developments in the options market, and you need to be prepared to make trades on very short notice. So that raises another variable in addition to the risk variable. How active do you want to be? How much work do you want to do? How much time do you want to spend on this stuff? So we now have two variables that distinguish how our different products fit together. Now, one question everybody asks is, what happens if there are disagreements between you guys? How do we make sense of that as an investor, as somebody who signed up for our newsletters? Well, it's true, we don't agree on everything. We differ in terms of our investment strategies, but also how we interpret developments in the market. For example, I tend to be on the bearish side, which is understandable since my beat is caring for people who are trying to preserve wealth and grow at the same time. Retirees, for example. On the other hand, you have people who have faith that despite the ups and downs of the market as a whole and the tribulations of the economy and politics, things are still going to grow over time and there's still going to be a lot of winners that we can pick. And here's where it's important to understand that there are two different kinds of markets you can invest in. And this is the third variable in addition to risk and in addition to how much activity you want to do in your investing. You see, even when the economy has a downturn, there are certain kinds of explosive investments in up-and-coming technologies, like Bitcoin, for example, blockchain, biotechnologies, things like that. Even if there's a downturn in the market, those things are still going to grow because they're at the beginning of their growth phase as industries. On the other hand, you have older stocks, dividend stocks, plain vanillas from the Dow, the Standard & Poor's 500, traditional stocks. Those stocks go up and down, and that's a different kind of investing. You're not looking at the next great thing, you're looking for the best companies in established markets. So there's a third variable, different kinds of markets that you can invest in. The more volatile, or rather the up-and-coming markets, tend to be a little bit riskier. They tend to have potentially higher growth if you pick the right stocks, but they also have the potential for losses if the companies that we invest in don't pan out. So there you have it, 3 variables to be aware of. So understand that when we ask you to consider looking at some of the other products that we sell, we're basically saying, hey, where do you put yourself on this spectrum? How do you see yourself in terms of risk? How do you see yourself in terms of how active you want to be as a trader? And are you prepared to get involved with riskier up-and-coming investments? All of these investments have great track records. They all make good money. They just require different things from you. They require different amounts of engagement, and they require different amounts of emotional and mental resiliency, particularly if you're in a risky market or if you're a retiree. So when we send you something that says, hey, look, check this out, it makes great gains, remember, we're just trying to give you the opportunity to consider it. We're not telling you that you must buy it. We're not telling you that it's better than the other ones, because they're all different. They're all suited for different kinds of investment strategies. So I hope that helps to explain the big picture. This is Ted Bauman. Thanks, and I'll talk to you again soon.